There is a peculiar irony in the way empires of money die, not with the chaos of war or the roar of cannons, but with the faint scratching of quills and the silent shifting of ledgers. When a financial capital falls, the world rarely notices immediately. Its demise is not cinematic. There are no flags torn down, no marble statues crumbling into dust. Instead, there are empty counting houses, interest rates that refuse to obey, and merchants who quietly move their ships and their trust elsewhere. Venice learned this lesson first. Amsterdam learned it better. London pretended to be immortal. And New York, with its skyscrapers of glass, may one day discover that mirrors cannot bear the weight of eternity. To understand why the fall of old financial centers gives birth to new empires of money, one must first understand how fragile these supposed citadels of stability really are. The myth of permanence, that ancient deceit of power, has fooled every city that ever thought itself the heart of the world. Each of them, in their golden age, believed that commerce, like their coins, could be stamped with immortality. But finance, unlike stone or steel, is made of something far more volatile: confidence. And confidence, history reminds us, is the most delicate currency ever minted. In the late medieval period, Venice rose from the marshes like a miracle. It was not just a city. It was a statement that human ingenuity could conquer geography, and that water could serve as both moat and highway. The Venetians were not warriors of land, but of credit. They learned that ships could fight wars, but loans could win them. While other kingdoms taxed peasants, Venice taxed ambition. Its merchants, cloaked in silk and suspicion, created one of the earliest systems of double-entry bookkeeping. They understood, centuries before economists gave it language, that power lies not in gold itself, but in the promise of gold to come. The Venetian economy became a theater of trust. Bonds were issued, debts traded, and risk became measurable. Venice, in essence, invented the idea that the future could be sold. But like all pioneers of finance, the Venetians mistook innovation for immunity. The Mediterranean was their private lake, until the Portuguese rounded Africa and the Spanish crossed the Atlantic. Suddenly, Venice's monopoly on spice and silk became a museum piece, profitable, but obsolete. The city that had built an empire on trade routes found itself marooned by geography and arrogance. What destroyed Venice was not conquest, but relevance. The world had simply moved on. By the time Venice began to fade, another city of canals and calculation was waiting in the wings. Amsterdam, the Dutch Republic, smaller in territory than most kingdoms' pride, understood something that Venice had forgotten. Financial power is portable. You do not need armies to rule the world. You only need to control the flow of capital. In the 17th century, Amsterdam became the neural center of global commerce. The Dutch East India Company (VOC), the first true multinational corporation, was not just a trading enterprise. It was a prototype of capitalism itself. The Amsterdam Stock Exchange, founded in 1602, turned investment into a public spectacle. For the first time in human history, ordinary citizens could buy a piece of empire. And with that, the idea of collective greed, democratic ambition was born. But behind the elegant facade of prosperity, Amsterdam's greatness contained its own fatal flaw: efficiency. The Dutch were too rational, too methodical, too predictable. Once they had built the machinery of global finance, others could imitate it and improve it. The British, with their peculiar mixture of chaos and calculation, would take the Dutch model and inject it with imperial ambition. Yet for a time, Amsterdam ruled the moneyed world. The Bank of Amsterdam, founded in 1609, was a wonder of fiscal discipline. Its paper receipts were as trusted as silver, its vaults a sanctuary of stability. But as Europe's wars multiplied, neutrality became a luxury. The very openness that had made Amsterdam powerful made it vulnerable. When the French invaded in 1795, the financial heart of Europe froze overnight. Trust, that invisible glue of commerce, evaporated faster than gold could flee. Amsterdam, like Venice before it, discovered that finance cannot float above politics forever. The irony is almost poetic. Every financial center is undone, not by ignorance but by mastery. Venice mastered trade. Amsterdam mastered credit. Both became victims of their own perfection. The systems they built worked so well that they could be replicated elsewhere, and once they were, their uniqueness vanished. History's ledger shows a repeating pattern. First, innovation, then domination, then complacency, then complace. And in the ruins of one empire's balance sheets, another begins to write its own. This cycle is not merely economic, it is psychological. Every financial center, from Venice to Wall Street, is built on the same delusion: that trust can be institutionalized, that confidence can be legislated, that money can be controlled. But trust is fickle, confidence is emotional, and money obeys only momentum. When the 18th century dawned, London began to stir. To the Venetians and the Dutch, the city was crude, provincial, almost barbaric in its appetite. But in that very chaos lay its genius. The British Empire would do what no city-state before it could: weaponize finance. The seeds of this transformation, however, were sown in the decay of others. Venice taught Europe how to measure risk. Amsterdam taught it how to monetize it. London would teach the world how to imperialize it. The Bank of England, founded in 1694, did not just manage the nation's debt, it turned debt itself into an instrument of power. For the first time, a government's credibility could be traded, and by extension, so could its destiny. But London's rise was not simply a British triumph. It was a Dutch inheritance. Amsterdam's merchants, fleeing political instability, brought their skills and their capital to London. The very people who once ruled Europe's credit markets helped build their successor. In this way, the fall of a financial center becomes the foundation of the next. Empires of money do not die, they reincarnate. There is something almost divine or demonic in this continuity. The temples of finance change address, but their gods remain the same: speculation, leverage, and the eternal worship of growth. Each city claims to be different, more ethical, more modern. Each claims to have learned from the mistakes of its predecessors. And each, in the end, succumbs to the same disease: hubris. Venice believed that geography was destiny. Amsterdam believed that reason was. London believed in empire. New York believed in the market. Silicon Valley believes in code. And yet, behind every new creed of progress lies the same altar of trust, fragile, invisible, and ultimately mortal. Perhaps that is the hidden tragedy of financial history, the belief that we can design permanence out of impermanence, that through clever systems, laws, and technologies, humanity can finally escape the cycle of boom and collapse. But history is a brutal accountant. It does not forgive hubris, and it never clears old debts. When Venice's last ship sailed, when Amsterdam's last ledger closed, when London's last gold bar crossed the Atlantic, each fall was not an end, but a transfer. Wealth never disappears, it migrates. Like a cunning animal, it sniffs out the scent of confidence and moves toward it. And every time, the new host city proclaims, "This time, it's different." It never is. The rise from the rubble when ruins became blueprints for wealth. If the fall of old financial centers was a spectacle of arrogance undone, the rise of new ones was theater magnificent, ruthless, and absurdly efficient. From the ashes of shattered empires came cities that refused to die, that reinvented themselves with a smile painted over the scars. The ruins became blueprints, the failures became philosophies. It was as if history itself had decided that destruction was not an end, but a prerequisite, a cleansing ritual before the next great illusion of wealth could begin. In the 17th century, Amsterdam had been the darling of the global market. She was the queen of trade, her canals pulsing with ships fat with spice and silver. Yet, as her influence waned, something peculiar happened. Across the Channel, London watched, learned, and sharpened its claws. The fall of Amsterdam wasn't a tragedy for London, it was a tutorial. The city of fog, soot, and opportunists realized that dominance in finance wasn't about geography or naviette, was about trust, illusion, and the art of convincing the world that money was safest in your vaults. And so London rose not out of virtue, but out of audacity. It learned to make risk respectable, to disguise speculation as patriotism. The Bank of England became less an institution and more a cathedral, a sanctified space where debt was rebranded as faith. Every bond, every note was a sermon promising that empire and economy were divinely entwined. But make no mistake, this wasn't providence, it was theater with better lighting. When Amsterdam finally exhaled its last breath as the center of global finance, it didn't die quietly. It transferred its organs, its merchant ethics, its trading systems, its speculative madness to London. The British merely gave it a new accent. They called it empire. But history as a pattern that adores repetition with irony. A few centuries later, London would face its own unraveling as the world wars tore the fabric of European finance. Bombs didn't just destroy buildings, they dismantled illusions. And from that wreckage, another city rose, one built not on centuries of tradition, but on the cold logic of opportunity. New York. There is something profoundly American about the way it happened. While London smoked and Paris mourned, New York calculated. It didn't inherit power, it bought it. Gold flowed into American vaults as Europe bled itself dry. The US dollar didn't conquer, it replaced. Slowly, quietly, and almost politely. Wall Street became the new axis of ambition, its skyline an altar to profit. But unlike London, New York had no monarchy to flatter, no aristocracy to serve. Its gods were anonymous corporations, syndicates, the invisible machinery of markets. Here, finance wasn't a gentleman's game, it was a blood sport. The rules were simple: be faster, smarter, and less sentimental. It was the perfect city for a new age, an age that believed optimism was a virtue and risk was the same as courage. The traders of Wall Street didn't think of themselves as gamblers but as pioneers, explorers mapping the undiscovered continents of capital. Their ships were paper, their voyages leveraged, and the world cheered them on because this time everyone wanted a share of the illusion. But every rise carries its own decay like a parasite. As New York expanded, the world began to decentralize. The once linear story of financial power, Venice to Amsterdam to London to New York, began to fracture. Money no longer needed cities in the old sense. Fiber optic cables replaced canals. Algorithms replaced brokers, yet, paradoxically, new centers still emerged. Hong Kong, Singapore, Dubai, H1 rising not despite the ruins of the past, but because of them. Take Hong Kong, for instance, a city born from colonial arrogance and geopolitical luck. When London's empire began to crumble, Hong Kong became its offshore echo, a capitalist experiment perched between East and West. It didn't need to invent trust. It rented it from Britain, packaged it in law and order, and sold it to the world. For decades, it functioned as a loophole, an elegant anomaly where financial rules bent like bamboo in the wind. Then there was Singapore, carved not from history but from sheer willpower, where others inherited. Singapore constructed. Its rise was engineered, clinical, deliberate, almost algorithmic. A city with no natural resources that decided information itself could be a currency. Where Amsterdam had canals, Singapore had data centers. Where Venice had merchants, Singapore had technocrats. And somehow, the world obeyed. Each of these cities, from London to New York to Singapore, followed the same hidden doctrine. When one center falls, another does not merely replace it, it absorbs its memory, its ghosts, and its sins. Financial history is less about innovation than it is about adaptation. The architecture changes, but the psychology remains. Greed disguised as vision, collapse justified as evolution. Consider Dubai, a city that rose from sand and spectacle. Once dismissed as a mirage, it learned from the excesses of the West and decided that illusion itself could be profitable. Here, capitalism is performance art. Skyscrapers climb into clouds not for utility but symbolism. Everything glitters, because that is the currency of trust in a desert of ambition. And yet, the deeper truth beneath these dazzling rises is profoundly uncomfortable. Every new financial empire is built upon the waste of the old one. The ships that filled Amsterdam's ports were built from colonial conquest. The gold that fortified London's banks came from plundered continents. The skyscrapers of New York were financed by wars and speculation. Each city's wealth is haunted by the collapse of another's dream. The historian might call this a cycle of renewal. The cynic might call it a relay of delusion. Both are right, because financial history is not progress, it's inheritance. And every inheritance carries debt. The irony is that the cities which prided themselves on innovation rarely invented anything truly new. What they mastered was transformation, the ability to turn crisis into opportunity, disaster into narrative. Venice turned trade into empire. Amsterdam turned speculation into science. London turned debt into dignity. New York turned optimism into ideology. And through each metamorphosis, the psychology of money evolved with almost biological precision. After all, markets do not have morals, they have instincts. They migrate, mutate, and survive. And wherever they go, they build new temples, new languages, new excuses for the same ancient desire to turn paper, metal, or code into power. When historians write of these rises, they use the language of triumph, growth, innovation, globalization. But beneath those sanitized terms lies something much older and far more human: fear. The fear of irrelevance. The fear of being left behind. The fear that the wealth you've built might evaporate overnight, as it did for Venice, Amsterdam, and London. This fear drives cities to reinvent themselves, even when they shouldn't. It fuels the skyscrapers that pierce the clouds and the currencies that promise stability. It is both the poison and the pulse of the financial world. So perhaps the true secret behind the rise of new empires of money, isn't brilliance, or destiny, it's insecurity. Every city that ascends does so because it cannot bear to be forgotten. And in that desperation, it builds monuments not to prosperity, but to memory. The ruins of the old become the foundation of the new, not because humanity learns, but because it refuses to admit it has learned nothing at all. The architecture of confidence. How cities learn to sell trust. Trust. That was always the secret ingredient, wasn't it? You can build towers of steel, pave streets in gold, fill vaults with the spoils of empire, but without trust, it all collapses like wet parchment. Financial history is, at its core, the history of confidence and illusion so masterfully performed that even those who built it began to believe it themselves. And nowhere was that illusion engineered more perfectly than in the great financial cities of the modern age. When New York rose from the dust of the Great Depression, it didn't merely recover, it reinvented belief. The skyline became a sermon in concrete, whispering to the world that capitalism could fall and rise again, stronger, sleeker, untouchable. Wall Street became both a street and a state of mind, a place where risk was reborn as religion. The trading floor was its altar, the ticker tape its scripture. Here, confidence was no longer personal, it was institutionalized. You didn't have to know the man who borrowed your money. You only needed to trust the system that said he existed. Bonds, stocks, insurance, derivatives, they were not inventions of finance. They were architectures of belief. Each layer of abstraction was another step away from reality, and another step closer to immortality. But confidence is a fragile god. It demands constant worship and periodic sacrifice. Every crash, every panic, every bubble that burst wasn't the end of capitalism, it was its ritual cleansing. Panic, in the financial world, is not a failure of logic but a lapse of faith. And faith, as history shows, always finds a new prophet. In the mid-20th century, as the world reeled from wars and rebuilding, the psychology of finance took on a new The Bretton Woods system promised a world anchored in gold and goodwill. The dollar, once a provincial currency, became the planet's lingua franca. Nations no longer needed to conquer, they could simply convert. Military might was expensive. Monetary influence was efficient. But this new confidence was even more seductive than before because it felt rational. Numbers replaced gods. Economists replaced priests. Financial centers no longer sold dreams, they sold data. Yet the illusion remained the same, a belief that markets could be managed, that human desire could be measured, and that the system, if well designed, would never betray its creators. It was, of course, another myth. By the late 20th century, the architecture of confidence had expanded beyond reason. London's Big Bang, deregulation of 1986 turned its financial district into a neon resurrection. A city that had once ruled through empire now ruled through leverage. The old stone facades of the City of London hid glass towers filled with invisible money, moving faster than thought itself. Confidence became speed. Whoever moved first won. Meanwhile, New York turned finance into entertainment. The 1980s weren't just about wealth, they were about spectacle. Money had always been power, but now it became identity. Traders strutted like gladiators. Greed was no longer whispered but celebrated. Greed is good, declared a fictional Gordon Gekko, and millions believed him because, in truth, the system needed them too. Confidence required contagion. And cinema, media, and politics became its transmission lines. Yet even as these great cities basked in their brilliance, cracks began to form beneath the marble floors. For all their grandeur, financial centers are ecosystems of emotion, fear, and euphoria traded in equal measure. The crash of 2008 was not a technical failure. It was a psychological implosion. The moment the world realized that its confidence was collateralized, bundled and sold back to itself. The very cities that had taught humanity how to trust had engineered their own betrayal. But, as always, the collapse did not end the story, it rebranded it. After 2008, a new kind of confidence emerged. It's digital, decentralized, and disturbingly intimate. The rise of fintech, cryptocurrencies, and virtual markets didn't destroy the old empires. It digitized them. The illusion became lighter, faster, and more personal. You no longer had to trust a banker in London or a trader in New York. You only needed to trust an algorithm, a blockchain, a faceless code that promised purity through mathematics. How poetic, after centuries of worshipping human ambition, finance decided that only machines could be incorruptible. And yet, the irony is that this too was faith disguised as logic. Algorithms don't eliminate greed, they optimize it. The new financial city Silicon Valley, Singapore's tech corridors, Dubai's AI-driven exchanges are not post-capitalist utopias. They are cathedrals of code, each promising salvation through innovation while quietly perpetuating the same psychology of trust and fear. Look at Singapore again, its glass towers gleaming with precision, its economy humming like a calibrated engine. It markets efficiency, prudence, and discipline. But beneath that veneer lies the same equation as Amsterdam's or London's centuries before. Control the narrative, and the money will follow. Singapore sells reliability the way Venice once sold spices. It's the same trade, updated for the age of data. Or take Dubai, its wealth, a mirage of light and spectacle. Every skyline photo, every record-breaking skyscraper is a message. We are the future. The psychology is unmistakable when confidence falters elsewhere. Offer a dream taller, shinier, impossible to ignore. Confidence, after all, is contagious, but so is envy. The truth, though, is far more unsettling. What we call financial progress is often just psychological evolution. We've learned not to abolish greed, but to aestheticize it, to dress it in glass algorithms and sustainability rhetoric. The modern investor is not less driven by desire than the Venetian merchant, he's simply trained to articulate it better. Today, the architecture of confidence is invisible. It hums in the servers of central banks, the encryption keys of digital wallets, the subtle choreography of global markets. We no longer queue outside banks and panic, we refresh apps. Trust has migrated from institutions to interfaces. The financial city itself has become virtual, a networked organism of belief that stretches from Manhattan to Shanghai. But even now, the psychology hasn't changed. Markets still move on whispers, not numbers. Fear still kills faster than debt. And every generation still believes, naively, that it is smarter than the last, that it has finally tamed the chaos. It hasn't, it never will. Because confidence is not built, it is performed. And every performance requires an audience willing to suspend disbelief. That's what Venice did with trade, what London did with debt, what New York did with optimism, and what Silicon Valley does now with code. The actors change. The illusion remains eternal. There's something almost divine about the pattern. Humanity destroys its temples and rebuilds them on the same ruins, convinced each time that this one will last, and perhaps it must be that way because, in finance, as in faith, the illusion is the function. Every skyscraper, every index, every cryptocurrency is just another mask for the same question: do you still believe? And the world, desperate not to face the void, always answers, yes, for now. The empire of illusions, how finance turned psychology into power. Confidence, as we've seen, is the engine of finance, but illusion, that is its fuel. If the history of money is a story of belief, then the rise of modern finance is a chronicle of how belief became manufactured, marketed, and monetized. What once grew naturally from trade and trust was now engineered by empires that understood something far deeper than economics. They understood the human mind. By the late 19th and early 20th centuries, financial centers had perfected the art of psychological warfare disguised as prosperity. The city of London, still pulsing from the veins of empire, learned to weaponize stability. The pound sterling, they declared, is as good as gold. And millions believed it, not because they had seen the gold, but because London looked like the kind of place that could be trusted. Tall columns, stone facades, men in bowler hats. It wasn't just architecture, it was theater. New York watched and learned. By the time the Federal Reserve was born in 1913, Wall Street had already evolved from a physical market into an emotional machine. Its power lay not in its ledgers but in its narrative. Every boom began with a story: railroads that would connect the world, technology that would save mankind, speculation that was no longer speculation because this time was different. The phrase became the sacred lie of every financial generation, and every collapse was the same tragedy: belief meeting arithmetic. But what truly made the 20th century different was the industrialization of illusion. Governments, corporations, and financiers discovered they could no longer merely inspire confidence, they could manufacture consent. Public relations became the new printing press of capitalism. The financial city didn't just build wealth, it built myths. Advertisements told citizens that buying bonds was patriotic. Newspapers framed speculation as innovation. The middle class was invited into the casino, reassured that they were not gambling but investing. And so, millions marched toward risk under banners of security. This was not deception in the crude sense, it was artful manipulation of mass psychology. The same forces that drove propaganda in war now drove confidence in peace. Markets didn't need to be rational, they needed to be believable. It's a cruel irony of financial history. Every time humanity tried to democratize wealth, it only democratized delusion. When the Great Depression struck, it was more than an economic disaster, it was a psychological collapse. Faith in banks, in governments, in the very idea of progress evaporated overnight. But even in ruin, the illusion adapted. Out of crisis came the New Deal, Keynesian economics, and the promise that governments could manage the business cycle. It was, in essence, a new myth dressed in mathematics, that human suffering could be charted, predicted, and corrected by policy. The financial empires learned quickly. If you couldn't prevent panic, you could narrate it. By mid-century, confidence was no longer an accident, it was an industry. The Federal Reserve spoke in riddles because markets didn't crave clarity, they craved comfort. Central bankers became oracles, their words studied like scripture. The illusion of control became a global export, spreading from Washington to Tokyo, from London to Frankfurt. And as the Cold War dawned, financial illusion became geopolitical weaponry. The West didn't defeat the Soviet Union through tanks or ideology, it won through the psychology of prosperity. The American dream wasn't just an idea, it was a balance sheet. Capitalism didn't need to prove it was moral, only that it was desirable. The sight of neon Manhattan was propaganda enough. But by the 1980s, illusion evolved again. It became personal. The deregulated markets of Reagan and Thatcher weren't merely policies, they were acts of psychological liberation. You, the citizen was told, are no longer a worker, you are an investor. The stock market ceased to be a distant arena of elites. It became an intimate theater of hope. The average man bought mutual funds not for dividends but for identity. Wealth had become self-expression. Yet this personalization of finance carried a quiet cruelty. Because when confidence collapsed, as it always does, it was no longer their fault, it was yours. You hadn't read the market correctly. You hadn't invested wisely. The illusion had turned inwards, and guilt became the new tax of capitalism. And so, financial cities flourished again, not as places of trade, but as temples of aspiration. Tokyo in the 1980s glittered like a hallucination of eternity. London rebranded itself as a global hub, promising to be both ancient and modern, traditional and progressive, a paradox sustained only by narrative. Meanwhile, New York, the ever-hungry Leviathan, devoured every crash and emerged stronger, like a phoenix fed on its own ashes. But illusions, once globalized, cannot remain contained. By the turn of the millennium, the world had entered the age of financial simulation. The digital revolution didn't just accelerate trade, it disembodied it. The city itself ceased to matter. Finance was no longer a place, it was a presence. Algorithms replaced traders, screens replaced trust. The illusion no longer required a cathedral, it lived in the glow of your monitor. This was the final triumph of financial psychology, the virtualization of belief. In this new empire, emotion became data. Every click, every purchase, every anxious refresh of a portfolio was recorded, modeled, and monetized. Artificial intelligence didn't just predict the market, it shaped it, feeding off human behavior in real time. The illusion had gone self-aware, yet, beneath this dazzling circuitry, the same ancient pattern persisted. People still feared loss more than they desired gain. They still mistook momentum for meaning. They still confused confidence with truth. The fall of Lehman Brothers in 2008 exposed it all again, an empire not of gold or labor, but of collective imagination. Mortgage-backed securities, collateralized debt obligations, these weren't real instruments. They were metaphors, elaborate poems of trust written in incomprehensible syntax. When the world stopped believing, the illusion shattered. And yet, even then, humanity refused to learn. Within years, the same cities that had burned were rebuilt, the same traders re-employed, the same slogans revived. Recovery, they called it. Innovation, they claimed. Quantitative easing, they named it a euphemism, so elegant it almost sounded merciful. But what it truly was hypnosis. The illusion had evolved again. Central banks became magicians of liquidity, conjuring wealth from air, manipulating not markets but minds. Confidence was no longer restored, it was engineered. Every press conference, every interest rate decision, every cautious phrase was a psychological instrument, designed not to describe reality but to create it. This is the paradox at the heart of modern finance. It survives not because it is real, but because it is believed in collectively. And that, perhaps, is its greatest genius. Because what is an empire, if not an illusion everyone agrees to respect? Rome had its gods, Venice had its trade routes, London had its navy, Wall Street has its spreadsheets. Each, in its time, was the same phenomenon, a consensus hallucination built from ambition, maintained through fear. So, when we speak of financial centers, what are we really describing? Not just buildings or institutions, but theaters of persuasion, places where psychology becomes policy and narrative becomes currency. To rule in the age of money is to rule the human mind, and no empire, however vast, has ever managed that more completely than the invisible one we inhabit today. The empire of illusions reigns not from capitals, but from confidence. It commands not soldiers, but screens. It asks not for loyalty, but for belief. And as long as that belief endures, the system stands gleaming, fragile, magnificent. The eternal cycle, collapse, reinvention, and the psychology of financial resurrection. Every empire believes itself eternal until the morning it wakes and realizes the world has stopped believing in it. So it is with financial cities, those glittering capitals of illusion, forever reborn upon the ashes of their own arrogance. The death of a financial empire is never sudden. It begins quietly, almost politely, with a tremor in the numbers, a nervous whisper in the markets, a subtle tightening of the collective breath. And yet, long before the collapse becomes visible, the faith sustaining it has already begun to rot. Confidence decays from within, like wood eaten by invisible termites. Until one day the facade of the marble columns, the trading floors, the dignified speeches simply gives way. But unlike political empires or dynasties, financial centers never truly die. They simply mutate, a kind of phoenix of speculation, forever emerging from the wreckage of belief. Amsterdam gave birth to London. London gave birth to New York. New York midwifed Tokyo, Singapore, Hong Kong, Shanghai. Each successor arises proclaiming itself more efficient, more rational, more democratic, and each in turn succumbs to the same ancient disease, hubris wrapped in innovation. In this sense, the history of finance is not a line of progress but a loop of delusion. Consider Amsterdam in the 17th century, when the stock market was born in the smoky halls of the Dutch East India Company. It promised order, liquidity, and prosperity, mechanism for turning private greed into public growth. For a time, it worked. But as soon as speculation outpaced trade, as soon as paper wealth detached from ships and spices, the illusion began to devour itself. Tulip mania was not about flowers, it was about faith, the belief that desire alone could sustain value. Centuries later, in London, the South Sea bubble repeated the ritual. Investors sold reason for fantasy, mortgaging their sanity to the idea of infinite gain. When the dream collapsed, Parliament wept, and the Bank of England was born, proof, as ever, that failure is simply the prelude to institutionalization. Every disaster becomes the excuse for a more elaborate illusion. New York, of course, perfected this pattern. The Roaring Twenties were not merely exuberant, they were evangelical. Wall Street had convinced America that speculation was patriotism, that the market's rise was the nation's destiny. Then came the Great Depression, the purgatory of belief, and out of its wreckage emerged the gospel of Keynes, the doctrine of managed confidence. The cycle had completed itself again: collapse, regulation, optimism, and rebirth. Each time humanity declared, "We've learned our lesson," and each time it lied. The truth is that finance cannot exist without faith, and faith, by its nature, cannot resist excess. The same psychological forces that drive religion drive economics: hope, fear, envy, and the desperate need for meaning. Every boom is a sermon, every bust a confession. The chart of any market, when viewed honestly, is not a measure of value but a record of emotion, of optimism ascending into mania, and of fear plunging into despair. But in the modern age, this emotional rhythm has accelerated beyond recognition. Where once generations passed between bubbles, now they unfold within decades, even years. Technology has compressed human psychology into algorithmic speed. The digital trader does not even feel greed or panic, his code does. And yet the same ancient illusion persists, that risk can be tamed, that the system is self-correcting, that this time the phoenix will rise without burning. It never does. When Lehman Brothers fell in 2008, the world momentarily saw the machinery behind the myth. We glimpsed the gears and pulleys, the derivative shadows masquerading as wealth, the towers of debt built on air. For a heartbeat, the illusion faltered. People whispered of reform, of restraint, of ethical capitalism. But within months, governments rushed to rebuild the stage. Central banks flooded the markets with liquidity not merely to rescue finance, but to rescue faith. Because in this empire, the true currency is not money, it is belief in money. And so the phoenix rose again this time. Digital, faceless, algorithmic, the global financial system was reborn, not in banks but in clouds of code. Cryptocurrency evangelists preached decentralization as salvation, forgetting that even the blockchain depends on collective conviction. In math we trust, they declared, never realizing that trust itself was still the linchpin. The illusion had gone cybernetic, but its essence remained ancient. This is the paradox of financial civilization. The more sophisticated it becomes, the more primitive its psychology. We build algorithms to eliminate emotion, only to find that those algorithms amplify it. We globalize markets to stabilize economies, only to make them vulnerable to a single tremor of doubt. The network expands, but the faith holding it together grows ever thinner, ever more fragile. And still, the cities rise. Singapore gleams as the 21st century's temple of liquidity, its skyline a monument to efficiency and discretion. Dubai builds glass towers in the desert, conjuring wealth from sand and oil and speculation. Hong Kong clings to its identity as a bridge between East and West, while Shanghai dreams of global dominance, whispering the same promise every empire once made: we will be the new center of the world. But beneath every promise lies a prophecy, the prophecy of exhaustion. For as long as finance exists, it will mirror the psyche of its creators. The city that commands money commands the imagination. It seduces humanity with visions of control, of mastery over chaos, only to remind it cyclically that no empire can outwit entropy. Wealth accumulates, corrupts, collapses, and reassembles. Confidence rises, wavers, breaks, and renews. The rhythm is eternal, and the audience never leaves the theater. That is the genius and the tragedy of financial history. It is both progress and repetition, revelation and relapse. The tools evolve, the psychology does not. The empire of money is the empire of mind, and minds, as every philosopher since Plato has known, are fickle kingdoms. And so, each generation inherits both the ruins and the illusions of the one before. They rebuild the cities, rename the markets, rewrite the rules. They swear their version will be different, that transparency and technology will save them from the follies of their ancestors. But the ancient whisper returns. Greed is rational, risk is manageable, belief is enough, until the next collapse. Perhaps that is the real secret of finance. Its immortality is born from its fragility. The illusion survives because it must. Humanity cannot live without a story of wealth, without some shared fiction that transforms fear into ambition. The rise and fall of financial centers are not just economic events, they are psychological rituals, acts of collective rebirth. And when the next empire falls, as it inevitably will, we will again gather amidst the dust and the data, declaring that this time, finally, we understand. We will rebuild, not from truth, but from need. Because the story of money is not about numbers, it is about belief. And belief, no matter how many times it is betrayed, always returns. That, in the end, is what keeps the lights of the financial cities burning against the night.